Traditional versus modern banking models. When Daniel first started his business, his relationship with the bank was simple and physical. Every Friday afternoon, he would walk into a branch, deposit cash, and speak briefly with a teller who knew him by name. When he needed a loan, he sat across a desk from a relationship manager, handed over printed financial statements, and waited days, sometimes weeks, for a response. This was traditional banking in its purest form, personal, paper-based, and rooted in physical presence. Traditional commercial banking models were built on face-to-face relationship and centralized decision-making. Banks operated through extensive branch networks, and most services required physical interaction. Credit decisions often relied heavily on the judgment of experienced bankers who combined financial analysis with personal knowledge of the client. While this model fostered trust and long-term relationships, it was also time-consuming and sometimes inefficient. For Daniel, this meant planning his financial activities around the bank's schedule. It also meant that his success often depended on how well he could communicate his business story to his banker. In many ways, the relationship itself was as important as the numbers. However, as economies expanded and globalization accelerated, this model began to show its limitations. Businesses needed faster, real-time access to funds and the ability to operate across borders without friction. This demand gave rise to what we now call modern banking models. Modern commercial banking retains the core principles of traditional banking trust, risk management, and financial intermediation you can equal, but transforms how these principles are delivered. Instead of relying solely on branches, modern banks leverage technology, data analytics, and automation to provide faster, more scalable services. Daniel experienced this shift firsthand a few years later. Instead of visiting the branch, he could now log into a digital platform, view his cash flow in real time, initiate payments instantly, and even receive automated credit offers based on his transaction history. What once took days could now happen in minutes. From a scientific perspective, this shift reflects broader trends in information processing and network efficiency. Research in operations management shows that systems relying on digital workflows can reduce processing time by over 50% while improving accuracy. In banking, this translates into faster loan approvals, better risk assessment, and improved customer satisfaction. Yet, the transition from traditional to modern banking is not simply about replacing one model with another. In reality, most commercial banks operate in a hybrid model, combining digital efficiency with human expertise. Complex credit decisions, for example, still require experienced analysts, while routine transactions are handled automatically. For someone navigating this environment, whether as a banker or a business owner, the practical lesson is clear but versatile. Understanding both models allows you to leverage their strengths effectively. Personal relationships still matter, especially for large or complex deals, but digital tools provide speed, transparency, and control.